So today's presentation, we have a smaller audience. We're joking that people show up when when their portfolio is down. We get a huge attendance. When our portfolio is up, everybody just prefers to go enjoy life, I suppose. So let's review the key ingredients, what may happen in the future, and how that'll affect our trade. So here's the big key macro points. Trade talk remains positive. Equity market has proven to be highly dependent on positive trade talk data. And so anything negative that comes from that has created 5 to 7% sell-offs in the S&P 500 twice this year. Well, once in May, perhaps just from profit taking, but certainly in August when they raised the tariffs. So trade talks do remain positive, a little more positive from the US side than the Chinese side, but it's a mixed bag. We have Mark Rubio, who is aggressively trying to create legislature to fight back against China. We're seeing the Hong Kong drama escalate day by day. Rocky, welcome, Rocky. So the same general uncertainty from the markets continues right now in terms of the trade talks. So as long as they're positive, we want to use the loose collar to generate profit from the upside. Now, I don't think we're overvalued yet on the S&P 500. Otherwise, I would tighten up that collar. But the bigger things to focus on outside of that is that the feds continue, or rather the banks continue to not have enough money to make pretty much a guaranteed profit every night. They could be making millions of dollars loaning money overnight, but they have their books trapped. They cannot loan another dollar out with all the regulations trying to keep their reserves high. And JP Morgan, a bunch of banks were in a committee, I believe it was a few days ago. I just got to it yesterday. And he clearly stated the problems that they just don't have any money that they can lend because it's all accounted for. Now, what exactly is it accounting for is a bigger question. We do know JP Morgan probably took a little bump on the chin from the WeWork implosion, but what else? So that's clearly something to keep note of. And while the Fed says they're not doing QE, they have bought $200 billion of treasuries just in the last 6 weeks, and this continues. They've already told us they're going to do around 60 billion a month, and plus they're supposed to inject a one-time shot of an unspecified amount, perhaps 300 to 500 billion is the rumor Goldman Sachs has been putting out. And of course, these guys are all in cahoots, so it's no surprise that Goldman Sachs is quite accurate at predicting what the Fed will do and sending out their little reports before it happens. ECB is buying up 20 billion in their currency, which is a little bit more than the US. Used to be a lot more, but that conversion rate is getting closer and closer. So the general trend around the world is not only do we have lowering interest rates, we have quantitative easing, and it looks like China will jump on the boat. Now, they tried to clean up their books in 2018. Everyone copied them. That's when we had 98% of all assets in the year in a loss. And so hasn't yet happened, but we're starting to see signs that China is putting money in their system. In fact, they just put something like our repo madness, where it's an overnight lending thing. So it doesn't show up on their treasury book. It just shows up as this revolving loan. And they have put a huge one in this week, something like $200 billion to support their financial system. So with those in mind, it's hard to be negative on equities, which is why we continue to be long equities, despite this considerable problem in the banks. From my point of view, though, it does seem like the banks are getting bailed out. They're able to flip these treasuries for a huge profit. And if they bought the majority of these in December, January, February, the return on at least the long end of these treasuries is significant. Now, most of the asset purchases have been on the shorter end of the bonds. So there might be a little bit smaller profit, but when we're talking about even a 5 to 15% return on $200 billion, that's a lot of money that's being handed to these banks. And so their balance sheets are certainly becoming they're becoming freed up with dry powder to purchase whatever it is they like. And I believe that will be equities if this phase one deal does come through. So that's the big news that we have to keep in mind. I'm going to go to this presentation. Here's what I believe will play out. Now, of course, it's hard to predict too far into the future accurately, but this is really what I think could happen if we get a phase one trade deal. Now, I haven't outlined what may happen if either the phase one or phase two trade deal breaks down. But just so hard to time that. The Cold War lasted multiple decades, and so trying to predict exactly when the trade deal with China will break down or improve can be difficult. Right now, we're in a period of lowering rates, not just low rates, but lowering rates. Rates are going down around the world. We do not have inflation. China may have some food inflation, but that is a self-inflicted pain because they stopped buying agricultural products from the US, and they're trying to replace that with other countries who are just not set up to produce at the level we are. Plus, they're having a lot of disease from their pig herd. Something like 50 to 75% of their pig population has died. Now they're trying to make gigantic pigs, probably related to the pollution in China. Regardless, the corporations have access to cheap credit, and they're buying back their own stocks. The government is printing a huge deficit, record deficits, which makes it very hard to have a low GDP print or low earnings. And the consumer still is in good strength. So it's very hard to be negative on equities with a positive narrative on the trade deal. Now again, if the trade deal talks do break down, depending on what threats are made, we could expect some sort of sell-off in equities, but I still think it would be somewhat limited until we actually see earnings start to deteriorate. So this is our current allocation as of right now because of the positive trade talks. But keep in mind, even if the trade talks broke down, we most likely would not change this asset allocation because of the big macro, low rates, low inflation, and QE. We can just reverse the collar to profit from the downside on the SPY. So I'm going to flip through. I'm going to come back to these, but let's just review one more time the three setups. So we have the bullish loose options collar. It's where we sell a call option that is above the trading price. In this case, this example, we sold the 301 call when the SPY is at 298. This is just a hypothetical trade. And so you can see our maximum profit is $2.90 per share. And then we bought the put option that was also $3 below. And so our maximum risk is $3. So we have an even risk to reward ratio and profit from the SPY traveling higher. And this is something I'd like to do as long as the SPY is below 303, at least in this current period. Now, once we get closer to the November 15th signing and there's positive commentary coming out, I do suspect the market will try to predict a deal before it happens and make it more risky to own the SPY before that. So the SPY should break above 303 as we get closer to that period. And they're going to make it expensive for you to own the SPY ahead of that announcement, because if it does come through, the new target for the SPY is going to be considerably higher. And I got to fix that. Sorry for the typo. Leading up to this event, as we get above 300, probably above 303, I think there's gonna be a lot of resistance, and a lot of people are willing to sell those call options in that 302, 305 range. And it'll be hard for us to really break out of this all-time high until there's some catalyst, which would most likely be the trade deal plus the lowering of rates around October 31st as the next FOMC meeting. So we could get a little bounce from that. And then we're also looking out for this one-time injection. So once these banks get essentially $300 to $500 billion swapped out from treasuries into cash, I'm going to guess they're going to buy equities. So the tight option caller, as you can see, does generate a profit in three directions, but more so if we trade flat or up. It has a break even that's slightly below the trading price and very limited downside. So if we go up to that 303, 305 range, I suspect we'll just be bouncing around until we get a catalyst. And every pullback will push the TLT up higher. And then with this tight option caller, we'll have limited downside risk. And as long as the SPY just trades flattish, we can get a profit. Now, do keep in mind, potential profit on this trade setup is 3 times that of a tight setup. So the security and protection comes at a cost. Now, eventually, once we get extremely overvalued, or we get a negative catalyst in terms of the trade talks, then we go to the inverted options caller. We've called it the upside down option caller. And now we're selling a call option that's in the money and buying a put option that's in the money. And this setup is highly profitable if we actually get a down move. And this chart doesn't even illustrate the maximum profit because we close these out with some time premium. This chart is based on the potential profit at the close of the expiration period. And so because of implied volatility jumping when markets go lower and the time premium being left over, we can actually make more than that 195 maximum profit. So we saw this recently on the TLT when we had that quick sell-off in the TLT, and we had this exact setup. Our profit was greater than what the chart indicated as maximum profit. So those are our 3 setups. Let's take a look at what most likely is the natural flow that will happen in the markets. So we're in a low rate, low inflation QE period. The political environment is that nobody wants to deal with the debt problem, which would essentially be solved by probably quantitative tightening and raising rates. So we tried to do that in 2018, copying China, who was trying to tighten up their shadow banking and a lot of misallocation of capital. And what did we get? We got emerging markets crashing all of 2018, and then US stocks eventually crashed in Q4. And also gold crashed, bonds crashed, everything crashed. There was 98% of all assets were down in 2018. That's because we had a global quantitative tightening from all central banks. Now, did they do enough? No, and they're right back to where we were in 2009, lowering rates, printing money. Now, typically they won't print money until there's been a massive stock crash, but the slowdown in China is happening at such a rapid pace that all the central banks are freaking out. We've seen 80% of all central banks lower rates and slowly move towards quantitative easing. So what happens? What stops this gravy train? Rising inflation. Most likely, as we do this QE, we will eventually get signs of inflation. Now, right now, that's been very low in the US, at least with the way they calculate it. And that's what's scary about this. Is we know there's massive inflation out there right now, but they adjust the formula for it each year to try to artificially keep it lower so they can keep this bubble growing and not have to pay the price of massive debt. We're up to $288 trillion of debt around the world. And it's all trapped in these different financial products. But as it begins to escape and make it into the real economy and to your average Joe, that's when you get that price inflation. So And again, I have these different folks I primarily listen to for market predictions and what to focus on down in the bottom. And so those are Stanley Druckenmiller, Ray Dalio, Jeffrey Gundlach, and Warren Buffett. And so we'll look at the different market cycles here that are most likely to occur. So this is our setup right now. If we get bad trade news, we can change this positive on the SPY to a negative, as well as emerging markets, and make extra profit to the downside. We won't change our asset allocation at all. And so all we'll do is do that inverted option caller on the SPY in emerging markets if we get negative news. But I'm not going to be willing to be short the equity markets for very long periods of time when interest rates are low. It's just absolute insanity. And until we actually get a breakdown in earnings and some real trade disruptions. So far, global GDP has slowed down from 3.8 to 3, but that was already happening because China is trying to clean up their economy and their debt, which they've grown massively, extremely massively over the last decade, especially. So eventually, the most likely outcome that ends this party will be rising inflation as they do QE and eventually stop doing the lowering of rates. So when will this happen? I'm thinking it could probably happen between 2021 and 2022. This is primarily based on Ray Dalio's expectation. He says we're in the 7th inning. And so in this environment, if we get the hint of rising inflation, we want to be negative on the TLT. And then this is most likely going to be the big hurrah and the big gains in the precious metals market. So we will have pumped tons of money into the system. We should see a strong rally in gold during this period. But once we see the rising inflation, that's a nightmare for the TLT. So we'll be doing that inverted collar on the TLT. And during this period, again, without some sort of major panic, we should still be able to be long both precious metals and equities. But because of inflation fears, rates are going to start to rise. And as the bond market starts to price that in, TLT will fall. That's when we're going to have to time selling our precious metals and prepare for rising rates and no quantitative easing. And this is an environment where typically the bond market will have sold off already and become much higher yield. Once those yields get too attractive, think about if the 30-year Treasury jumps to 3.5, and we're rising interest rates and not printing money, and stocks are at all-time highs. That's where you get your big sell-off. And so during this period, which could potentially be from 2022 to 2027, we may be in a period where we have to keep interest rates high because we have so much inflation from all the money printing that's escaped from the financial markets. And this is where we would be short the SPY. Again, with that inverted collar, we may use SQQQ, an inverse ETF for our Tuesday play to help increase that general trade. We would be long bonds, so interest rates will have already risen dramatically and are going to start coming down as people flee from the stocks and buy up bonds. And now that we have high interest rates, it makes sense to just have money in the bank. You'll get a nice interest rate from the bank. Now you go back to the 70s when we had runaway inflation. They had to jack the rate all the way up to 20% at the federal fund level to fight inflation. And then we get Alan Greenspan. So we went from Paul Volcker, who was crazy with his rates, pushing them up really high, pulling them back down. Inflation came back, pushing them. I'll show you the chart in a minute. So the end of this, the reset, I call it the Great Reset. We'll have high rates. We'll have gotten all the malinvestment out of the market. All these corporations who are living on selling debt and buying their own shares are out of business. It's a cleansing that the world really needs. but the politicians and the populace won't vote on until it's unavoidable. And so again, that inflation is what will force the hand. Now, the next period would be a lowering of interest rates and the potential for quantitative easing. And so this will be after a massive stock crash. Yields and bonds will be significantly higher. And then your Warren Buffett strategy would really come into play. So I would look at what his biggest position is at that period. And I'm just expecting potentially it would still be Apple. So our buy and hold position would jump into Apple. And I would still argue Warren Buffett's the greatest stock picker of all time, so I wouldn't try to outthink him. But in terms of having diversity, we might switch out the SPY with the QQQ, and emerging markets will be strong. Now you can notice we would go into LQD instead of TLT. So knowing that we're in the 7th inning of a massive bubble, the biggest bubble of all time, we're in a 50-year credit cycle, not just these 10-year mini cycles. We're playing the safest assets right now. So we have the SPY and the TLT. But after a massive reset, that would mean stocks are down at least 50%. Rates are up from, right now, 1.75 at the federal fund rate. I'm expecting they will have to jack it up above 5% to offset the inflation headed. We jump into LQD. So that's the investment grade bond fund. Still something like owning the SPY, but now you're loaning money to these corporations who have survived the reset. So we can make a lot more money on LQD than TLT. I just don't want to jump into that when we know a lot of the bubble and a lot of the problems, especially Jeffrey Gundlach is especially concerned with the LQD ETF. There's companies like General Electric, AT&T, who have massive, massive debt in that fund, and they're probably misrated. They should probably be in the junk bond ETF instead of the investment grade, where they're coupled up with companies like Microsoft and Apple. So that is most likely what I see happening for the next several years and how we would slightly adjust. So you can see we're not changing the assets much or the amount of shares. And we can see what's going to force their hand. It's most likely going to be inflation. Now, could this play out a little different? Sure. But for now, that's really what I am most concerned about, is a pickup in inflation forcing the Fed to raise interest rates. So I'm going to pull up some quick charts here. Now, a lot of you guys are starting to see why we like that TLT SPY combo. This chart just shows stocks crash, TLT pops up, but in general, they're both rallying together in a low inflation environment. And so the net effect is it makes it very hard for us to have a serious decline in our total assets. Here's 2008 crash. You can see SPY crashed 50%. TLT went up 40%. Didn't completely protect you, but it did a great job allowing you to continue to play the markets. Now, if you had our put options below, perhaps we cut our SPY losses in half, and then the TLT generated a nice profit. And you have seen our strategy has done very well during pullbacks in the first 11 months we've had this program out. Here's a couple more examples just showing you the correlation between the SPY and the TLT. And again, this whole long SPY, long TLT works until we get to 0 on the rates. And then we know we can't go any lower than that. So this gravy train for this exact setup is going to run out of steam as we get closer to 0%. Yeah, please, Rocky. What question you have? See if you're unmuted or not. Okay, I unmuted your mic if you want to talk out loud. And you can also, it looks like you're self-muted, Rocky, but if you want to type a question, you can, or you can find your mic. I'll continue the presentation until you get a chance to ask a question. So here's yet another example of a bull market. And of course, SPY went up 51%. TLT didn't get crushed. It only went down a maximum of 20%, but ended that period only down 2%. So the TLT does provide a huge insurance to our equity position without a lot of downside risk in an environment where there's low inflation and lowering rates. Now, in terms of gold, the price doesn't stay still for very long, and there's just rare periods where it makes sense to be long gold, and it's when the Fed is buying treasuries and cutting rates, and then you wait for some sort of panic, and usually, you got to remember, the Fed usually cuts rates and buys treasuries when there is considerable concern. Otherwise, they wouldn't be doing that. So this is a great time to be long gold because of those factors. And also, gold does provide another level of uncorrelated returns that makes it further more difficult for us to. Yes, yeah, Rocky, I think SPY will go to the 315 to 330 range. We have two big catalysts ahead. October 31st FOMC meeting. They're most likely going to drop interest rates 25 basis points and maybe announce a one-time injection of $300 to $500 billion, which is going to free up the banks to buy stocks. So right now they're giving them overnight lending, and they've secretly bought up $200 billion in treasuries that went straight to the bank's balance sheet. So they now have $200 billion they could be putting in stocks. But the big event is this phase one trade deal coming up in November 15th is the potential signing. So I think we'll trade range bound in the 300 to 3.5 range until we get closer to that November 15th date, where I think it could have quite a jump to the upside. Right, so if the banks are in a period of lowering interest rates and printing money, we want to be long stocks. And the TLT for that matter. All right, now let me pull up some slides about interest rates and inflation. Okay, so the big question is, when does our long bond, long stock strategy break down? And in general, Rocky, our strategy is not necessarily reliant on predicting short-term moves, which is very hard. You know, there's a famous book called The Random Walk. But what we can do is look at what the policy is of the central bank and realize that their actions dramatically affect the markets. And so their actions right now are to lower interest rates and to buy bonds from the banks. So this is freeing up the banks' balance sheets to have cash. Now, whether those banks want to buy bonds or stocks will probably be highly dependent on earnings and this trade deal. So if the trade deal does move forward, I'd suspect the SPY can travel to 315 to 330 from what's been discussed in this phase one deal. If the trade talks break down, we'll have to see what the reaction is from each side and how much of an impact that will really have on corporate earnings. But in general, if there was some sort of breakdown in the trade talks, I would only want to be short stocks for a very short period of time because of the big picture. And by having a good ratio around 50-50, right now we're slightly overweight in stocks, it's hard to lose because when one goes down, the other goes up. And in general, the big picture is we can see these rates go to zero at the federal fund rate before this strategy should break down. But what could stop it before it hits 0%? Well, rising rates, the end of QE, And those only happen when we get primarily inflation. So when have we had inflation? Well, we've had it when there's too many government subsidies and there's too much money printing by the central bank. So World War I, we did a whole lot of money printing and then had post-war inflation and deflation. During the Cold War, it was actually quite bullish for stocks until we had massive inflation. When we have inflation, the Fed has to hike up interest rates, and then that's very bearish for both the TLT and for stocks and for the SPY. So what are they using to magically determine whether they got to hike up rates? They use this CPI index, but they change it each year, which is remarkable that they would do that. And so here's a good chart showing this trend, which is in a downtrend right now. We're in a downtrend in rates, and most likely the lowest the Fed would consider going is to zero. So as we approach that zero level, we know that's the end of the rope for the bond market. They most likely won't go to negative rates without doing massive QE. So probably we have a year, 2 years at most, where they can get away with this slowly but surely dropping interest rates. Most of the great depressions and market sell-offs have been during headline CPI popping up. So we can see the dot-com bubble, the 2008 bubble, the 70s and 80s, where we had a 15-year pullback in stocks. That's from inflation. And so what is the Fed's strategy? Well, the red line is the federal fund rate. The blue line is the CPI index. And so when they see that CPI index start to pop up, it's very simple. They move the interest rate level considerably higher, and then prices drop. So does GDP, so does lending, so does everything. So it's a way to get all the bad investments out of the system. And it's something that America really needs, to be quite frank. But none of the politicians or people who vote understand that or want that, because it will be a period of hard times. And you can see every time they pop that, the yellow line is the federal funds rate here. So what happens every time they spike that interest rate? We get the very rare negative GDP prints. And that's when stocks crash, because finally the earnings show the drop in revenue growth. So that's how simple it is. But once we look in between the lines, you'll see where the complexity gets. So now here's the different Treasury rates, and you can see they're just so magnetized by the federal fund rate. And so as they adjust that, if we can predict the general trend of the federal fund rate over the next year to two, we have a good idea of whether interest rates going up or down. And so that TLT is primarily that pink line. And right now, it's quite obvious they are lowering rates. Everyone's lowering rates, and they will until this GDP growth stops slowing down. So we went from 3.8 world growth a year ago to 3 this year. And primarily because China's GDP has gone from 14% down to 6%. And they've been the main growth engine over the last decade. But the problem is they've increased their monetary supply dramatically. Trillions of dollars have been printed and just circulating in their little closed system. So the scary thing is the inflation's already here. And if you've seen the riots all around the world, from Lebanon to France to Italy to Hong Kong, even in the US, what's the big picture? Well, the big picture is that the core costs, which are housing and medical, and education, have skyrocketed, but our incomes have stayed relatively flat. So people are not happy. Their cost of living has gone up, but their income has remained the same. So we're seeing a worldwide phenomenon of populism of people hitting the streets protesting. They don't know what has gone wrong, but they know they're not happy and they know they can barely get by. And so government, for whatever reason, likes to manipulate that CPI price so that it doesn't force the Fed to raise rates. They can go out there saying there's no inflation. But yet you can see all the industries that the government has subsidized or protected, primarily college, medical, and housing, are all guaranteed by the government in one way or another. And what's happened to the inflation of those products? Well, the efficiency of capitalism has gone out the window, and you can just see what would happen with a state-planned economy. It's not efficient. Now, here's an interesting website that takes the old formulas and shows you what the inflation rate would be. So if we go back to 1990 CPI, well, we're sitting on 5% inflation. So the federal funds rate should be around 5% right now. Bond yields on that Treasury should be probably around 6 or 7%, because that's the inflation rate. But no, we say the last print was 1.7. You go back to 1980, it's not only near 10% inflation rate, it's in an insane uptrend. So to think there's no inflation coming our way, and to think that this bull market will continue indefinitely, that we're just in the greatest productivity boom of all time, is foolish. And you can just see how mad people are all around the world because of this phenomenon. Now, sure, strong employment is great, creates a lot of buying, keeps these GDP numbers up. But as wage inflation, as the corporations run out of quality labor to hire, and you have to start bidding higher and higher for that labor, cuts out the profits, creates inflation, and can pop this whole bubble itself. Take a quick look at our returns over the last few days. So we started off the month with 1.1% return, mostly from the TLT spiking. And then we got the surprise trade deal. I thought Trump was going to get mad, but he didn't. He said we got a phase 1 trade deal. We're going to drop the December tariffs, and they're going to buy a bunch of agricultural products. That's the same thing they told us in July. They've been saying this for 2 years. So we'll see what really happens. Is China really in enough pressure to do something? For now, we have to go with the narrative. The market is tied to this narrative, which is bullish. But let's just look at our return in October popping around. So it started off record profit 1.1, first 3 days of October. Trade deal came out. I didn't have proper protection on the downside of the TLT. If there's anything I would take back about our trades, I would have on Friday or on the Thursday before the trade deal, I might have risked us paying a little bit more premium on our put on the TLT. So in case a trade deal had occurred, we wouldn't have lost so much on the TLT. Bond market sure did not like that, and rates went significantly higher after the trade deal came out. We reacted immediately, went to a stronger equity position, and it's working. So here's our returns. October, on the 16th, we were down 0.5%. On the 17th, we were down 0.3. TLT was still finding a bottom, but we're making profits on the SPY. Negative 4% by the 18th. 21st, the TLT took yet another tumble, and this is when the SPY was getting back towards its all-time highs. So we had a maximum drawdown on this date of the 21st, which was just on Monday. But we've seen the TLT climbing back up because it's quite clear rates are going lower. Global growth, at least across the pond, is slowing down, and we're about to have massive stimulus. So as of yesterday, we were down 0.3, and as of today, we're only down 0.2. And so I suspect we can hopefully get back to a profit for the month by Friday and squeak out a nice gain by next Friday to close out the month. As again, our target is to hit 1% a month with very little drawdown. So that's it in a nutshell. Let's see if we have any questions out there. I'll pull up this. So yeah, Rocky, if you know, it's just too hard to predict exactly what will happen in the short term. That's what the beauty of this system is. By having the bond SPY, the TLT SPY ratio, and understanding that we have lowering interest rates, we have quantitative easing, we can be long both of these products and have very, very few chances of a significant drawdown in our portfolio. And again, where's the end of the rope for this? For the bond market, it's going to be as we approach 0%. We're at 1.75. They're trying to slow this down as much as possible. The Fed would love to not go to zero. The Fed would love to not print money and bail out these banks, but they need to. The banks are completely out of cash. They can't even lend money overnight. That's what this repo madness is all about. So it's either that or the financial system goes to a freezing halt. So rates are going to go lower until these major uncertainties stop and until the growth picture recovers. So again, we went from 3.8 GDP growth, world growth, to 3 in the last 12 months. Much of that is just China slowing down all on its own. But put on top of that, the US is putting financial pressure on their economy, and now they're slowing at a much rapid speed. So that is why I think they may want a period of ease by accepting a trade deal. And it's also becoming apparent that the political leaders that are running for office, none of them favored China except for Joe Biden, and he's pretty much been ruined by this whole Ukraine-China scandal. So I think that we will get a trade deal around November 15th, and that will be very bullish. So as far as price targets, I think there's limited downside risk on the TLT if we get a trade deal. But I will play it a little safer. I'll risk some more money on the put for us as we get closer to that date. I'm not going to sell a close covered call on the TLT because we want the shocks to the system to result in the profit on the TLT. So we can't sell a close call option and achieve that. So we'll probably bite our tongue and pay a little extra premium on the put around, let's see when that date will be. So the earliest date, most likely, that we would get official news that there is a phase 1 trade deal would be November 15th. That's perfect. So on the 14th is a Thursday when we trade the TLT. So expect on the 14th, I may buy extra protection for our gold position and our TLT position. So if a trade deal does occur, we're going to be set up to get a massive profit on that period. So November 13th, 15th, 18th are the SPY trades for that month around that period. So we'll probably be paying extra premium for put options on the whole basket on that lead up to the 15th. And if the narrative plays out, we'll deliver the profits on the SPY and the emerging markets. And our put options will kick in on the TLT and GDX. But if the narrative fails, the put options on the SPY and EEM will kick in, and our TLT and GDX can go up substantially. The beauty on this is we have limited downside risk on TLT and GDX because the central banks are supporting the bond market by printing money and lowering interest rates. So the downside in the TLT is very limited compared to equities. Does that all make sense to everybody? Any questions? Dean, I unmuted you in case you wanted to chat.
Hey, Jason, thanks. Hey, Ron, I just wanted to reach out and see if you had any questions. I know you've been following us for about 3 or 4 months now and haven't seen you in a and a live presentation. So just wanted to check in, see how things are going for you, and see if you had any questions. And then, Tom, I'll be calling you Friday morning at our set time, okay, to get you on the boot camp.
Well, good to hear, Ron.
Okay, nice.
And
Cool.
yeah, so Tom, this is just a little sneak peek at part of the education on the boot camp. So I do want to point out it's not going to be, I've looked at a lot of the educational products in the options market. They're completely technical. They're teaching you they're teaching you how to load your gun maybe. They're
Hocus
certainly
pocus.
not teaching you how to hunt though. So the goal of our boot camp is to teach you how to hunt, not just how to load your gun.
Yeah, it's so funny. Everything in technical analysis, and you're so right. It's all hocus pocus. It's the financial system and the macro that drive 100% of price action.
All right. Now, I do like to listen to some technicians because
Sure.
they have a good idea of figuring out where these price levels will jump to based on catalysts. So I do listen to a few technical folks. In fact, I'll show you one I really like. But man, all the hocus pocus they love to pull up, it just cracks me up.
Yeah. Well, there's lines in the sand until the financial system changes what it's doing or the macro changes what it's doing.
Yeah, exactly. So here's my favorite technician, Northman Trader.
Yeah.
He's got a good YouTube channel. He does a video once a week. Very smart guy, runs a fund, makes it onto CNBC. Somewhat, he's got a bearish slant for sure, but he's not completely just, he'll discuss the potential for upside and downside risks, and also looks at a lot of fundamentals. But he's very interested in technical trends, looking for gaps, looking for prices to fill these different. He's got a lot of good stuff, certainly, but all of his predictions relate to something happening on the fundamental side too. So. Ron has a question. The short call and the TLT is trading at 2 cents. Should I buy it back or leave it alone? Yeah, leave it alone. So TLT is our insurance policy right now. I'm not predicting huge profits on the TLT during this period, but I'm also not predicting any major risks. Now, we had the big sell-off, so rates are relatively reset, and you can see it's starting to slowly climb back up. So I think we'll see the TLT trade flat or slightly up, and the SPY try to work its way to the stock market loves to get ahead of the news, predict what the news will be, and make you pay to have the potential for the reward. And so I would suspect as we get near that November 15th date, the markets are going to make it expensive to have exposure to the SPY to benefit from the outcome. Now, they also like to try to make it I've also noticed these big banks will try to create some, they know there's a positive catalyst ahead. So leading up to it, they may do their best to scare the weak hands out and sell really hard, only to turn around and buy it up aggressively and to try to properly price in what the potential reward would be to hold it into these catalysts. So again, if we just look at the big picture, we know the bonds will save our ass when there's any kind of pullback in stocks, but we know we want to be long stocks right now, and it makes sense to do our exact strategy. Hey, Oscar, how's it going? Let me unmute Oscar. He got in here. We had a good presentation today, Oscar, and I'll get the replay out a little later today. We talked about really what I think will happen for the next 20 years and why, and how long each period should be. Any questions, Oscar?
One question, Jason.
Sure.
The one question I had is yesterday on the 12 o'clock, you showed a profit for the EEM position, but you showed 8,900 shares, which would be an investment of about 370K. Was that a particular allocation you had? Because I've been following your allocations based on the 1.2 million or whatever.
I mean, yeah, it does seem like it's too much. Let me just double check what's going on.
When you calculated the profit, it was on 8,900 shares, and that's where I got kind of thrown off.
Right. Yeah, no, I understand the discrepancy right away. Let me double check that. Okay, I'm gonna have to close this and open it up, and it'll automatically pull up my track record.
Sorry for causing so many problems.
No, you're not causing any problems. That's a great question. Thank you.
And by the way, I had it jotted down for 2 o'clock, but I didn't figure out the difference in time.
Oh, no worries. No worries at all.
So I'll look at the replay.
Okay, I'm gonna close this. 1 second. I'm gonna pop it back up and it'll pull up my Okay, so you are correct. In terms of the growth of our returns, that is accurate. So, we're at negative 0.4%. So here's the discrepancy. So we can go over that. So our portfolio has 3,800 shares that generated that profit, not 8,900. So that was a mistake on my end. But that calculation in the document does not affect our spreadsheet or the returns we're
Right. Okay.
So yeah, good catch. And
It was driving me crazy because
yeah,
I'm saying I could have sworn he had a different allocation.
no, good. Hey, I love to be called out and first to admit mistakes. So let's review.
There it is. Net result.
Let's review the mistake. So so this is correct. The profit loss in this chart right here is correct. As of that date, the profit per share is correct. And I don't know if you guys have noticed this. When I know we're going to change positions on the Tuesday play, I'm trying to tell you guys that way ahead of time. And in this case, we went from silver the previous week, which would have been great if we got the fear aspect from a breakdown in the trade deal. And I was caught off guard on Friday. I did not think they're going to come out saying, hey, we're best friends. We're going to have a deal. So we sent you guys out the alert Friday saying, oh, shit, get rid of the put option. We got to go long equities. And then Monday, we told everyone that we're going to be doing emerging markets. So if you did jump into emerging markets on Monday instead of on Tuesday, you had an extra 30 cents a share. So our profit was calculated, at least in this little clip right here, was based on Tuesday, not on Monday. But just a tip for you guys, if I know we're going to switch to the Tuesday, if some major paradigm shift has happened, which was the trade deal going from, if you think about it, leading up to that Friday, US was being ultra nasty for the 2 weeks leading up to it. So it was very confusing. We had the Chinese buying agricultural products, trying to play nice, but we had Trump at the United Nations speech calling China enemy of the state, all kinds of nasty things. We had 18 companies sanctioned. We had this Hong Kong bill getting passed by Mark Rubio and all these people. So it was looking pretty ugly for a trade deal leading into that Friday. I had you guys positioned to profit substantially if that trade deal It didn't even have to get nasty. It just had to not happen. Instead, they did the press release after the market closed, said, yep, we're best buddies again. This is looking great. Phase one deal. Same thing they said in July. But if I know for a fact we're going to rotate because of the paradigm shift, I'll tell you guys a little earlier. So yeah, you're right. So this figure right here is not correct, but this doesn't tie into my track record at all. So the whole track record's right here. So you're correct, 3,800 shares, approximately 10%. I've got 11.7.
Perfect.
Yeah. And definitely watch the replay after it comes out a little later, Oscar. We had some really good content. I went into part of the module 1 of the boot camp, and we looked at the big picture. We looked at inflation. We looked at how government manipulates inflation and how long I think this long bond, long stock strategy can last. Probably about, I'll pull it up one more time. Hey, Karen, how's it going?
Hey, I think I figured out what was going on.
Made it.
Yeah, I didn't realize it was 2:00. Well, I've just been very busy with family stuff, so I'm trying to catch up here very quickly. So,
Oh, no worries. I'm going to
Yeah.
sum up, just because you and Oscar are two of my favorites, so I'm going to sum up what you missed. But
Okay,
if you
good.
have time, watch the replay later when it comes
Yeah,
out.
trying to get those done. It's been a little complicated this week. So yeah, whatever you can do to help me out, I appreciate
And
it.
and actually, yeah, I think once the boot camp starts, I'm probably going to push our start time on webinars an hour later, just so I have a little break between the live stream. Just a heads up.
I
You
think
guys would have been right on time if we'd already made the time slot change.
That's what I went off of.
Okay, so yeah, I'll just do a quick summary. And if you guys want to rewatch the replay, you can, but I'll try to cover the important stuff. So we looked at the correlation of the stocks and the bonds, how it magically makes it very hard to lose money, especially when you have those puts. And so you guys see that in the daily video. I won't go over that too much. But the big picture right now is the Fed is printing money. And we can see that in the far corner there, $200 billion in the first 6 weeks. They're lowering interest rates. Now this chart doesn't show that very well, but they have begun the process. And the third thing we want to pay attention to is the CPI, which is a 1.7 last print, very low. So if we have low rates, low inflation, and quantitative easing, this is our current setup, SPY, TLT, emerging markets, GDX. Let me pull my calendar just because I want you guys prepared for this. Actually, I'm not sure if I can pull it up easily. Let me see if I can get a Google Calendar up.
Yeah, I'm taking a look at your trade right now to try to put it on, and it's changed again. It makes me crazy when it does that.
What's changed? Oh, the prices?
Yeah.
What's the SPY at right now?
299.07.
Oh, okay. Well, and I think when I took the screenshot, it was like 250 or 290.50.
Right, but the
299.50.
option prices have changed considerably. Let's see here.
So yeah, so if you want to get the same risk reward ratio, here's the little secret. So look at the screenshot, the last trading price when I put it on.
Right.
So if it dropped 50 cents, the underline, you could get the same risk reward ratio as I had by just dropping the strikes 50 cents.
That's what I was going to look at. Yeah, that's kind of how I think you were thinking. Good.
Yeah, so we get the exact same setup that way. Now you don't need to, it's not going to offset the results that much, but okay, so here's what we're looking at. So going back to the 11th, that's when Trump did the phase one trade deal. And what I was telling everyone is my biggest regret on that was not being skeptical of a trade deal. But I do believe on Thursday, it would have been intelligent to have paid a little extra premium on our put on the TLT. Because that would not offset the potential gain we would have had on the TLT if we were right and the trade talks broke down. But on the other hand, it would have helped reduce the volatility this week if this outcome had happened, which was the trade deal. So to not repeat that mistake, here are the key dates ahead where we want to be probably paying a little extra premium for downside risk on the TLT and gold. FOMC meeting on the 31st, 25 basis point cut, maybe the announcement of a huge injection of liquidity to the to JP Morgan and Goldman Sachs and all those guys. They're probably going to get, between all of them, I'm guessing around $300 to $500 billion before the end of the year to get rid of this money market issue. So JP Morgan and all those banks were on TV recently, and they basically just said, look, we've completely run out of cash. We're allowed to loan with all the regulations. Now, what's actually tying up all that capital, we don't know, but they're not willing to make a pretty much guaranteed profit overnight because they don't have a penny left over that they can loan out and still abide by all the regulations. So the central bank has to resolve this, and Goldman Sachs been rumoring it'll be about 300 to 500 billion bucks. It's a lot of money going into the banks, and so they'll get rid of these treasuries and have cash. Now, will they jump on stocks? Probably, most likely. That's what I'm expecting. So downside risk on the TLT and gold is somewhat limited because the banks are lowering rates, because they're printing money, because China's growth is significantly slowing down. So I'm not overly concerned about the TLT or the GDX in the long run, but to try to keep our monthly return as with as little volatility as possible, I might pay a little extra premium for the puts on gold and TLT on two key dates. So the 31st could be a pretty bullish move catalyst for stocks. A little less worried about that date compared to the next month. So bigger concern would be on the 15th of November. If they announce the phase one trade deal and sign it, that could give us another TLT panic. Now, I don't think TLT is going to crash on us because we haven't fixed any of the uncertainties with the trade deal. We're just getting kind of like a relief rally. So I would suspect on the November 14th, I will pay a little extra premium on our put for the TLT, and I might even buy us a put on our gold position. So if we're right, and this trade deal's, well, if the narrative is correct and the trade deal is signed, stocks will certainly soar at this point. And I believe they will get expensive leading up to that because the market does not like to make it easy to front run these catalysts. So I would suspect we could see some interesting volatility, just trying to scare people out, and then a rally into this catalyst, which will either be sold significantly if the trade deal fails, or rally significantly if it is signed. Now, is that going to fix all our problems? No. We got Wilbur Ross talking about phase 2, phase 3, talking about how we don't even have to do the deal on the 15th if it's not the right deal. So that, looking back, that is something I regret, is that we didn't pay a little extra premium. I mean, for literally 50 cents, we could have wiped away about 2% of drawdown. So I do regret that. Now let me pull up this.
Oh, that's interesting. That's a good thought.
Yeah, in hindsight.
I frankly never thought about that.
Yeah, if we had given up 50 cents per share or per contract, Yeah, we would have had a lot less volatility.
Yeah, but we can never always be right. Only my wife is.
Yeah, I'm slowly
Well-
learning that one with my wife. Fast learner of
Universal, my
most
friend.
things, just
Universal.
not with dealing with women, I guess. No, just kidding. Although you, Karen, I feel like you're
Hold on a
easy to
second.
get along with.
Oh, yeah, until you do me wrong, and then that's it. Get out of my way. But no, no, that's true. You guys are learning. It's all about compromise, isn't it?
Yeah. So let's say we phase one breaks down. Are we really ready to predict a long-term bear market in equities? I don't think so. I think we'll have a short-term sell-off from a phase one breakdown, and we'll have to judge how significant that sell-off will be based upon what comes out. So probably if they can't sign a deal November 15th, we're probably not going to get some nasty message right out the gate. It probably will just be December 15th tariffs are in place, and then go from there. So I think any short-term volatility in equities, we can use our inverted collar to profit from that. TLT will pay off, gold will pay off, but I'm not ready to be subjectively short equities for a very considerable amount of time while we have lowering rates. Not just low rates, but lowering rates, low inflation, and probably it'll ramp up the quantitative easing if that happens. So this setup should do us well for quite some time. Now let me pull up one more chart. How long can this setup right here last? And there's a pretty clear signal when this strategy will break down. There's two things, but most likely this will be the first one. Let me just pull up this chart. So this is the band that the rates have been trading in for the last 4 decades. And so it's quite clear we're in a downtrend on the federal fund rate based on the inflation rate. Now, are they goosing the inflation rate? Sure, certainly. We spent some time talking about that. But what's the lowest they can go? It's, they're saying it's 0. Other countries are going below 0. I would suspect the Fed won't go below 0, and then they would switch over to massive QE. So this long bond, long stock strategy is very powerful until we get to that 0 bound. So what would happen is we approach the 0 bound on rates. Let me pull up my chart. So this is the setup I like currently. This is extremely correlated to Stanley Druckenmiller's portfolio. Extremely correlated. He's one of my favorite investors. He's averaged 30% a year for 30 years. This is extremely close to his exact setup. Now, he can't have fun with the option market like we can because he's trading too much money. But this is extremely close to his exact setup currently. It's a little heavier in gold. But other than that, he's got almost all of his equities parked almost exclusively in Microsoft. But that's the biggest position in the SPY. So what happens next? Well, eventually, I believe the central banks will do what they like to do. The only thing they can do, why would they give up their own purpose? They want to support the economy and try to elongate the business cycle. Well, they only have one way to do that. It's to lower rates to 0 and print. But what will happen eventually to stop that is inflation. So every time there's inflation, they have to hike up the rates. When they first start doing that, that would be negative for the TLT position. So we're not going to get rid of the TLT. We'll just do that upside down or inverted collar. But this will be the period of time where we get the final hurrah, most likely in stocks and gold. And so, and also silver. So as we get closer to that 0 bound, I'd flip out the emerging market for a potentially bigger return on silver. Also, if we thought the trade deal was breaking down in this environment, I want to be long silver too. But eventually, inflation starts to perk up. Now they're talking about asymmetric inflation above 2%. So how hot will they let the inflation ride before they stop the QE and they start to jack up rates? Hard to guess, but this will be our outlook as we start to see the inflation prints getting hotter and hotter. And after rates are rising and quantitative easing has stopped, that's pretty much into the gravy train for gold and stocks. And so we'd be able to go back to our TLT, and this is probably when we get the big stock crash. So rates will be on that long end of the Treasury so attractive. You know, imagine inflation's in this 2% range, and you can get a 3.5 or 4% return on a 30-year Treasury. It's going to be too tempting, and this will flood market out of equities into safe assets. And we'll have that period of time where it makes sense just to own dollars again, put them in the bank and get paid a heavy interest rate. So I think rising rates eventually will occur from inflationary fears. And so
Does it make sense to be in equities at that point?
So yeah, we want to ride equities until it gets too attractive. So that it'll be fancy timing on this part. But look at my time horizon. So I think we got about 2 years, and we're running out of 2019. I think we got about 2 years where they can draw out this process of slowly lowering rates. I mean, if they only do 25 basis point cut and they can spread it out every 3 months, then we have the potential for 7 rate cuts over 7 quarters. So that's how I got about 2 years. I think they could draw out this process for about 2 years. So it takes us through the election. So that's when the party stops. Either we hit zero or inflation starts to perk its head. But the inflation's not going to escape to the general economy if it's all stuck in stocks, bonds, and real estate, which is where it's stuck right now. So we've got, like Ray Dalio says, Ray Dalio's made more money for hedge fund investors than anyone else in history. And this strategy, guess what? Very similar to Stanley's. They're very, very similar. And so he's not beating the markets to have the biggest hedge fund in the world. He's doing the same thing we're doing. That's what everybody wants. They want to make a good return with low risk and low drawdown. And so he's predicted we're near the end, but we're not there yet. So he has very similar portfolio as this as well, except he's been predicting the bond market would sell off early. Same with Jeffrey Gundlach. So they were a little early on that. Now, Druckenmiller was not. He's been pitching TLT since December on Bloomberg, all over the place. But you got to remember, these guys are managing so much money. They have to be the first to predict it. They have to be against the crowd to change all their money out, and then to be prepared for what happens next. So it's a lot more difficult for them to trade the markets than it is for us, because we can react on the snap of a finger. So eventually we either get to probably both. We're probably going to get close to that zero bound, and we're going to start seeing inflation prints pick up. Now, that's not going to be the end of the world for stocks until rates get too expensive and money just doesn't make any sense to be in stocks. So I think during this period, stocks and gold will be at all-time highs, and bond yields will be going up. And eventually they get think about the October crash last year. Same thing, we had rising inflation, and bond market was selling off. Stocks were doing great all year 2018 till about October, and then the bond prices got so attractive, the yields were so attractive that the equity market puked its brains out and jumped on that TLT. So probably we'll see our best gains in the stock market As we get close to that zero bound, his QE is really ramping up, and inflation's still at a level that doesn't freak people out. Now, I will say the amount of inflation the market's able to withstand as the debt bubble gets bigger and bigger has become smaller and smaller. So we used to be able to deal with like 7% prints back in the 50s and 60s, and as long as it came back down, the markets were fine. Now, we saw in the dot-com bubble and in the '08 bubble, we barely got to 3% inflation, and everything went haywire. So this will be the trickiest period right here, is trying to realize when we're getting near a top and getting into a shift. So this will be the period where we take our profits on the equities and the precious metals, and most likely bond prices are crashing and yields are going up, and the Fed is starting to slowly but surely announce, and they like to tell us, oh, inflation's getting hot, but we're going to let it run a little longer, a little longer. They've been telling us they want to make up for the low levels of inflation to make up for, they need to devalue the currency because it hasn't devalued fast enough. And then this is what Jeffrey Gundlach has been predicting this year. He was so accurate 2018, 2017. Not so much this year, and I think he was a little early. I think perhaps he didn't realize, well, I don't know, he's been predicting the tariffs. Eventually, we get rising interest rates from the Fed, and they stop the QE. And that's when we want to short. Leading up to that event, and sometime during that period is most likely when we'll get the big pullback in stocks. And so that's when we'd flip short stocks, long bonds, and long the dollar. Now, what interest rate you get to?
You're shorting the QQQs there.
SQQQ plus. So we would just buy and hold that inverse QQQ ETF.
Yeah.
So yeah, we could just buy that. We'd still use the collar, but so yeah, for the biggest position in the portfolio. Now again, these prices will be different. So this is just at current prices, but it just shows you which instruments we'll use. So if rates are rising, not a whole lot to profit from here. So we're going to predict that this will be after rates have risen significantly. That's when we want to go back into the bonds, which will be cheap, and then sell short stocks, which will be expensive. And then you can just put a little cash pile on the side. That's our buy and hold during this period. And then the last cycle is, okay, we've wiped out all the malinvestment. Lots of corporations are going to be going. Think of the dot-com bubble. Think of all the companies that went bankrupt. Think of the '08 crisis. And we just went and bailed out a bunch of banks in that one. Some went under. They did let some go under. But this will be the period where it's been the great cleansing. Interest rates are very high. And just think of that period where we went from Paul Volcker jacking up rates to 20% to Alan Greenspan coming in and saying, okay, I think it's time to start lowering these rates down. And so we'll have wiped out, hopefully, a lot of, think about all these companies. They're just losing tremendous money. They're selling bonds. They're buying their own stocks. They're not generating profits. There's going to be a great cleansing of these companies. And then that's when we can go to more of a Warren Buffett strategy here. And that'd be a period where rates are dropping and there's expectation for some stimulus. So let me pull up that chart. I actually have some with the all right, so here's our Cold War Wikipedia slide. Just notice, this low inflation period was very bullish for stocks. Lots of government subsidies during this period, lots of It was the Cold War. We were printing tons of money, but inflation was remaining low until it didn't. And then all of a sudden it spiked in the late 60s. And this is exactly the top of the stock markets, 1965. And then you had 15-year pullback. And you had inflation they couldn't get control of. So here's your stock market, 65 through 80, 15-year bear market. Sure, there's some rallies. Yep. And that's exactly when this guy was dropping the rates. But you can see inflation came, Paul Volcker, inflation comes, he jacks up the rates, you get a recession. Jacks up the rates, you get a recession. Jacks up the rates, you get a recession. The bull markets come right after these recessions as he's lowering rates. But in general, we had this long period of raising interest rates. And then the opposite came through. So they finally got all the malinvestment out and inflation disappeared. What did we get? One of the best stock market rallies of all time, from pretty much unstoppable. There's a few fears here. Oil scare, Black Monday, but in general, just one of the best bull markets. But what was happening? We went from extremely high rates down to very low rates. And so there's the last two bubbles, and you can see we popped above 3%, and that freaked out markets. But there's a correlation to malinvestment, to money printing, to lowering the rates, to all of a sudden you get inflation, and you got to reverse the course. So here we are now. $288 trillion of debt to service. The market's now extremely sensitive to rate changes. So I don't think we'll get anywhere near those interest rates that we saw back in this period. But I think it would be realistic for them to try to get it above. As soon as we do have inflation, they may try to get it in that 4 to 6% range to fight off the inflation. But right now, they're printing 1.7 on the inflation data. Let's see if I have that up. 1.8. So it started to get a little hot in 2018. Then we did quantitative tightening, and what did we get? Sell-off in equities. And now they're back to lowering rates, printing money. So most likely they'll do that until they can't. The other scary thing is how they calculate this. Can make this a little bit. The best way to figure out when they're going to hike rates is to pay attention to all the other central banks, primarily China and Europe. But here, let me pull up this inflation data. So here's the band we're in. 0 is most likely the bottom of the range for current system we're in, with the amount of debt we're in. You can see all these recessions were right around when inflation popped. We can see in the blue line, we have the CPI, and in the red line, we have the federal funds rate. And their strategy is quite simple. When they see inflation perking up, they jack that rate up above, and that causes a lot of problems, causes a lot of malinvestment to go bankrupt. That's when we see these negative prints are right around when they jack up the federal funds rate, cut off the money supply from all these companies, and everybody swimming naked under the water is exposed. Good Buffett quote. We can see that the Treasury rates are a magnet towards the federal fund rate, which makes it somewhat easy for us to play the TLT. They do like to give us a pretty good heads up of what they're going to do. But this is what's the most alarming. They're adjusting the CPI calculation over time to keep that rate low so they don't have to increase rates and put the world through a period of recovery, which would probably be good for it, but no one wants to take the medicine today. They want to delay it to tomorrow. If you go to the 80 CPI thing, you can see formula. You can see it's not just at very elevated rates it's in an uptrend. So they should be, I mean, it's quite clear. We have zombie corporations. It's just a huge debt bubble. And the question is, when are they going to pop it? And the good news is they do like to, that's why I spend the majority of my time listening to these Fed speakers. They do a decent job at telling you what they're planning to do. Now, that's not always the case. They went from December telling us automatic rate hikes and quantitative tightening to completely doing the Powell pivot. But we were seeing those yields in the bond market well before that announcement. So we can look at where the market's pricing bonds as a leading indicator, and then we can see if the Fed is reacting to that and then forecasting what their plans will be. But last thing, I'll leave you guys with two things before we go. One, this picture really shows you there is massive inflation. That's why we're seeing so many protests around the world. Many countries now have people protesting. The general problem is that the central banks have elevated, really the main one is the cost of housing and medical. And so wages have not increased at a rate of 90% or 170%. So despite them manipulating the CPI price, people in general feel broke and they're upset. They don't really know what went wrong. They just know they can't afford their lifestyle anymore. So that's why we're seeing the populism all around the world. So at some point they're going to raise rates. That's what's going to happen. Now I want to jump one last thing to show you guys, and we'll get out of here for the day. Just want to show you guys some of the tools I use throughout the day in case you guys want to do it and do something similar. We're now recommending Ameritrade over Interactive Brokers, free trades. Two, if you want to download the Telegram phone app, in the next week or two, we're going to start issuing trade alerts on Telegram app. Sometimes your phone carrier will randomly block our text messages, and there's just nothing we can do about it. Telegram does not do that. So if you do download the Telegram app, we'll have a channel that will post the trade alerts, so you can just open up your phone app and get them. So that's something to consider. If you haven't yet, download the YouTube phone app, and I'll be giving you guys a list of the key people I follow. It changes over time depending on what's going on, but I'll give you guys a list of folks I do listen to if you do want to do it. I like to use the save to watch later thing. So if you click on the little three dots on the video and save to watch later, you can build yourself a list of content. I have a never-ending list of content to watch that I have never been able to get through all the way. Rakesh wants to know. So right now the allocation breaks down in a $75,000 lot. Unfortunately, because of the price of the SPY, it doesn't break down into a $100,000 lot. So you can either follow the strategy with 75 or 150, but not 100 to have the same setup I do, Rocky. But you should have the buying power to get to that right level. But yeah, so you wouldn't be able to accurately follow this with 100 because you'd be overweight in the SPY. Here's some of the people I've followed in and out, but it's much less now. Next, I like the YouTube TV app. I primarily watch CNBC, Fox Business, Fox, and CNN using that phone app. So it is a subscription, but very useful to be able to have those on the go on my phone.
Got a big mailbox there.
Yeah. Oh yeah, that's my personal email. I don't ever check that one. 89,000. Twitter, I'll give you guys a list of here's the folks I primarily follow right now. I try to keep that as little as possible, otherwise your Twitter feed gets completely insane. And there's really so much overlapping content, so I try to keep that significantly reduced. Recent is for me to start following Nancy Pelosi, McConnell, and Warren as we're getting closer to the election and impeachment threats. Another app I like is the Bloomberg app. I like to follow the commodities market, the futures market, and the currencies markets, as well as the rates markets from their phone app. It's free. And there's some screenshots of what it looks like. One of the better indicators for predicting turmoil in the trade deal is the breakdown of the yuan against the dollar. Part of that phase one trade deal may be an agreement to keep the CNH in a certain range. So that's why we've been on hold to short the currency. And if we get a phase one deal, that rate may even strengthen to the yuan side. So phase two, I don't think will happen. So I think that'll be leading into that period of time, probably when we can finally get that trade off. Next app I like to use is Seeking Alpha. They have the ability to create little groups. So up here you can see these different groups. Here's the different lists of stocks I have currently. And just a quick, easy way to see all the charts. But more importantly, it will find articles handwritten by very niche writers. These people tend to be experts at a specific stock or ETF. And so this will automatically pop up a feed of news related to your stock list. So that's pretty cool. Free app. Some other slides from it. Roku Express I found very useful. It's the only product out there that does support both the YouTube TV app and the YouTube normal app. So I have one upstairs in our bedroom and in the living room so that I can throw on the YouTube TV at any time and either stream my saved watch list or listen to anything live that I need to listen to. So also, they have a ton of stuff on there, pretty much everything except HBO you can add to your YouTube TV account for like $50 a month, so it is a good deal if you're spending a fortune on Comcast or DirecTV or anything like that. Next, I know some of you guys I've noticed love this stuff as much as I do. You'd spend all day doing it, so don't feel like you need to. It's just an idea of how I'm able to maximize my consumption of info each day. I've got a little Bluetooth speaker and another phone. The YouTube TV app has to be open. You can't close it, so I don't like to lose access to my normal phone. So I do have a second phone that just sits there, and I'll pretty much play one of these live streams almost all day. Like today I was listening to Zuckerberg congressional hearings. Another useful tool are the Bluetooth earbuds, a lot better than the plug-in ones. If you ever had your cord rip the earbuds out of your head, I like to do this when I do the dog walk or drive to the store, pick up the kid. And then finally, I found trying to read articles on the internet, especially on a site like Zero Hedge, which I don't by any means read Zero Hedge's every article. There's too much content. Definitely handpick the articles out of that. Reading them on the phone is a pain in the butt because the ads pop up. Reading them on the computer screen is a little bit awkward too. This Fire HD product you can pick up for like 50 to 80 bucks. Beautiful screen. You can talk to it. It does all kinds of stuff. You can buy books on it, but I like to use it to read Zero Hedge articles. So that's how you can cram about 18 hours of content into your head a day with the least work possible with all those little phone apps and tools and gadgets. All right, guys, any last questions before I let you go?
Thank you, Jason. Very informative, always.
Oh, thank you. It's a pleasure to serve you guys. And let's see what we got tomorrow, the TLT play. So probably be a pretty wide collar on the TLT. as it's our insurance play and we don't have any big catalysts to cause fear until the end of the month, and then November 14th. So.
Well, thank you for your time, the extra time you put in.
Yeah, my pleasure. And I don't think you guys need to watch the replay now. We pretty much covered everything twice, so you guys are set to jet.
Well, I'm a little slow, so I probably got to do it again.
Yeah, and I do too, because I got interrupted a few times. Sorry.
No worries. Okay, cool. We'll have it out to you this evening, and I appreciate everyone as usual.
Thank you.
We'll see you tomorrow.
See you tomorrow.